All right, boys, how are we doing?
Feels low energy today. What's going on?
Great. How are you?
What's going on?
Let's go. Let's do this. I love this. I love it. Let's go.
Love it. All right, you're hot. You're coming in hot. Well,
yeah.
Breaking news.
Yeah.
Breaking news. Biden has announced his capital gains tax hike. I don't think this impacts any of us, but Biden will propose almost doubling the capital gains tax rate for wealthy individuals from 20% to, not 25, not 28, 39.6% to help pay for the social spending and inequality. For those earning $1 million or more, so nobody on this call, federal tax rates could be as high as 43.4%. The capital gains increase would raise $370 billion over a decade, yada, yada. For New Yorkers, the combined state and federal capital gains rate could be as high as 52.22%, and Californians, 56.7%. Biden has previously warned that those earning over $400,000 can expect to pay more in taxes. This was just breaking news a couple of hours before we started the pod, and the stock market is down, and people are freaking out.
J-Cal, I want to hear your take on this, actually. I want to start with your take.
Why did you tell me Biden was going to do this? I would have voted for Trump. You didn't tell me this is going to hit me so hard.
No, J-Cal was ranting on this topic 15 minutes ago. We were talking, and I'm like, dummy, what did you think was going to happen? You know? He's sitting there going off. It's like, what did you expect?
Just before we get into it, we should do a quick primer on what this means, right? So capital gains taxes are the taxes you pay when you make an investment and you sell that investment at a profit. That you pay a tax on the profit you make. And there's a difference between capital gains on the short term, which means less than 1 year, and long term, which means you've had the investment for more than a year. So economic policy historically has dictated that having a low capital gains tax rate relative to what an income tax rate might be incentivizes people to make long-term investments, and it gets more money moving in the economy, and as a result, the economy will grow. And so the idea of increasing the long-term capital gains tax from 20%, which it currently is, to 40%, is a real striking, economic policy shift, rationalized as, we're going to save, we're going to use this money for social spending. But I think the historical context and what this is really important as we get into the conversation. And just speaking historically, the maximum tax rate on long-term capital gains got up to 40%. Sachs, you probably have the history on this in 1978 for a year, right? Or like 76 to 78. And then it's been largely, 15 to 20% for the last 20 years or so. And so to jump up, and prior to that, in the early part of the 20th century, it was like 25% pretty consistently for a long time. So to jump up to 40% is a really big shift. And there's a lot of debate around the economic implications of doing this. I thought that was important. Yeah.
Let's take a step back and actually see the forest from the trees. And the forest from the trees is that I don't think Biden thinks that it's a credible plan, in as much as I probably think he needs, this is like, it's performative. Because it was a lot larger, the headline number was a lot larger than what people were whispering was going to be the number, right? It was supposed to be like in the low 30s or maybe kind of like, 33, 34. And then all of a sudden, like to come out at 39.6, I think it's almost like, okay, he's giving the pound of flesh to the left kind of like woke mob of the Democratic Party who probably doesn't understand how capitalism works in the first place and doesn't care because they're not participants in it. Now, my reaction is I don't think it's going to pass. I think it's going to be really tough to get done, and I think it probably maybe there's a watered down version, but this version I'm not super worried about. And then it just comes back to the same thing over and over. The fewer the number of people that get to participate in the growth and see the upside, the more there are that just wants to just kind of tear it all down. And so I don't know. It's just yet another signal that we have these structural issues to fix. It's not reasonable that a few people get super rich and everybody else gets left on the sidelines. By the way, think about what just happens to any organization that has to pay cap gains, right? It's not just individuals. Like last time I checked, organizations aren't exempt from cap gains, for-profit organizations. And I don't exactly know what they will do as well. So, you're putting a lot of people under a huge strain when you double the effective rate of return. So, if you're, for example, like a pension fund, right? And you have an enormous investment in a private equity fund or a hedge fund. Part of these things is that, they're these complete pass-through vehicles. And so as long as like you've structured yourself in a way where you don't have to pay that tax, I guess you're indifferent. But if you're any organization or institution or a person or collection of people that bears that tax, all of a sudden, your returns have been basically cut in half. That's pretty nuts.
Let's talk about the average Joe for a second, or Jane, as it were. 401ks would take a hit here, and then when you go to your retirement and you have to liquidate them,
you don't pay tax on the
you don't pay tax on that.
You don't pay tax on the 401k gains during
otherwise your portfolio, because 401k is going to be a small amount you can contribute to every year. So retirees who happen to have stock market gains or cryptocurrency, people trading that.
Yeah, you'll basically pay the same as income tax as opposed to paying a lower tax.
So
it'll diminish investment, Jason. It's exactly what David says, which is that on a marginal basis, what will happen is inflation probably goes up because people just decide to consume rather than invest because they think, well, what's the point? There's already risk that I bear. And so, the earliest risk assets, right? The riskiest ones that we all participate in, which is early stage venture and company formation. You may not be thinking about the capital gains rate, but it's implicit in the returns that you're expecting for the risk and the time you're going to take. And, we've been trained to feel that rate. And if you double that rate from 20 to 40, I suspect that there's a lot of people whose risk tolerance changes and they're going to feel their after-tax gains differently. And they'll wonder to themselves, is this worth it? And then I think what happens as a result is entrepreneurship drags. I don't know if anybody's done an analysis, but I suspect part of the reason why America is such an amazing sink for capital, right? It absorbs capital all around the world, is that you've created incentives that get people very excited because they think they can get rewarded. If you take those rewards away, I think the implications are much bigger than just the cap gains rates here. Because as the people change their behavior, then the capital formation pools outside of the United States change their behavior. And the whole thing has a knock-on effect. And it was more muted in Clinton. It was less muted in 78. It basically didn't exist in the 40s and 50s, but it is a huge force today. I mean, we are an indebted nation that owes money to all kinds of countries around the world, including China. We're supposed to generate growth and sort of pay it back.
And where will the growth come from if LPs don't want to back venture funds or venture funds?
But
maybe I'll check out.
Let's be honest and direct. Yeah. I mean, are any of you guys going to change your investment behavior if the cap gains tax goes to 40%?
No, but there'll be less of it, Yeah. So look, anything.
My behavior has changed.
I think my behavior will change. Yeah.
How will it change?
It's exactly what David said. So I just put in $100 million into a climate change company 2 weeks ago. Under this promise, I could only put in 50. So there's 50 million less progress that's going to happen on that business. I'm not sure that's the right answer for what that company is trying to do in the world.
And the way it will change.
You're saying the profits you would have had from before are diminished in half. Therefore, you would only have half as much money to invest as an investor.
So however way you want to cut it, whether it's like the 10 companies gets cut down into 5, or the 10 companies that I invest in get half my money. The point is, at some point, the money starts to run out. Not just for me, but for everybody else.
Basically, at the end of the day, the money goes into the hands of government legislators and administrators to decide how that money gets spent, and it's not in the hands of capitalist investors to decide where to invest.